Joining us for that is Tom Tzitzouris, who is Strategas Securities Head of Fixed Income and Research. Also, he's the lead fixed income portfolio manager there. And Tom, thanks for being with us this morning. What do you think about this conundrum we've seen in rates? How, the rates have had their own mind. The Fed hasn't really had control here.
Yeah, and this has been a very bad year for the bond market. And it's been a year, in fact, where both bears and bulls have looked like they've been wrong quite a few times along the way. But we would agree fundamentally with why yields are rising at this point in time. But we just think the bond market's getting a little bit ahead of itself. In particular, there's a few headwinds to further increases in yields that are likely to hit in early 2025. And so those headwinds have to be dealt with before yields can keep creeping higher. But fundamentally, it makes sense that yields have crept higher, even as the Fed has cut, because one, the market had priced in too many rate cuts for 2024 and 2025. And two, the market was looking past at that point in time when 10s were down to 360, the enormous supply that is going to have to come on board in the next few years as the Treasury, one, continues to finance large deficits, and two, begins to refinance the Treasury bills that the Yellen Treasury had pushed into the market over the last 2 years. So that has to be dealt with. And this is the big reason why yields are rising. But we got to get through this soft patch in the first quarter of 2025 that we think is going to hit. And we also have to get through the debt ceiling increase, which until that debt ceiling is increased, there's going to be a shortage of treasuries entering the market for at least a few months in 2025. We got to get through that too. So shorts are going to have to be very cautious about maintaining positions with yields at these levels, because there's a lot of risk that yields reverse drastically lower in the next few months.
I mean, I guess the good news is you're not talking about an inverted yield curve, at least between the 2s and the 10s anymore.
That's correct, especially with the Fed still likely to cut at least 2 more times next year, likely in March and in June. And even if they only deliver 1 more cut, you're looking at the Fed funds rate down to 3.75 to 4 and 2s around 4%. So 2s 10 spread should still be positive in 2025.
You know, the point you made about Janet Yellen and the treasuries that had been issued to this point, you're saying that that's the biggest reason for the issues right now because of the length of duration?
Well, it is as of today, but if you assume that we're going to be running trillion-dollar-plus deficits beyond 2025, then eventually, cumulatively, that will overwhelm the T-bill issuance. But we've estimated that between, we'll say, 2022 and end of 2024, the Treasury pumped about $2 trillion of excess T-bills into the market. Those are going to have to gradually be scooped and tossed out to the 5 to 10-year portion of the curve majority, and that is probably a bigger concern for the market right now than deficit next year. The deficit next year should actually come down materially versus 2024. So it's scooping and tossing those bills that's a bigger concern at this point in time.
Big question, though, is what happens with inflation? Is it stickier than had been anticipated? And what about the economy? How does it hang in there? What's your answer on those two fronts?
Well, I think they're going to be working against each other for much of next year. And what we mean by that is that inflation is probably going to be coming down for a little bit next year into, we'll say, end of first quarter. We think inflation is going to trickle a little bit lower, and then it's going to get sticky again around a 2.25 to 2.5. We're kind of there right now. And then during that period, you're also going to see, we believe, a soft patch in the U.S. economy, driven in large part, I think CNBC has written about this recently, credit card debt. It continues to be a drag on the consumer, and that drag hits hardest in the first quarter. So we think there's going to be a soft patch next year. But then, if you assume the economy reaccelerates, inflation is probably going to be going with it higher. So you're probably going to see in the second half of the year, you're going to see inflation trickling back towards 3%. And by the end of next year, it might be above 3% again.